Welcome to the latest episode of The Financial Frontier. I'm your host, Patrick Camuso. The IRS new tax form DA is going to mark the beginning of a formal reporting regime that's going to connect cryptocurrency to the U.S. tax reporting system permanently. And my guest, Miles Fuller, leads government solutions at Taxbit and is really at the forefront of implementing this tax reporting framework. And I'm very to bring him on as a guest today. We're going to break down what the 1099 DA really means for the industry, the IRS, and for digital asset compliance as a whole. Miles, welcome to the show.
Yeah, thanks for having me, Patrick. Excited to have a little chat today about 1099 DAs and crypto compliance here in the U.S.
Absolutely, yeah. I'm excited to get into the details here with you. So, you spent over 15 years at the IRS Office of Chief Counsel before joining Taxbit. How's that experience shaped your view on how the IRS approaches digital assets, and what experiences and insights there are you carrying over as you're working at Taxbit and working with the industry on, implementing some of this?
Yeah, there's quite a bit there on shaping it. Inside, during my time at IRS Office Chief Counsel, and I've dealt with the counsel office, I was a field attorney, which meant I oversaw examinations. I went to tax court, that kind of work. One of my areas of specialty was abusive tax avoidance stuff. And so when crypto came on the scene, that was obviously the first thing of interest, that there was sort of this novel asset class, must be inherently illicit as an emerging issue. So I was able to tackle it there and help on the IRS, how to do audits, how to think about the data, maybe how to crunch the numbers from a capital gain standpoint. And a lot of that exercise is what we're leaving, because there's a lot on the practitioner side, exact same problems. You're working with a client, they did a bunch of activity on one exchange or another exchange, then they did some non-custodial like on-chain activity in DeFi. First problem you have is data. Like, can I get all the data of the transactions that even occurred? And then once I get the data, then I got to try to figure out what the data is actually telling me. And if I can figure out what the data is telling me happened from an economic standpoint, I got to try to figure out which tax rules apply, where there's gaps, like what are the unknowns, that kind of stuff. So that's extensively since I've left. My time here at Taxbit, we still actually support the IRS with data processing for crypto transactions to help get it organized so they can make sense of the data.
Absolutely. And, the data quality, completeness, and the context surrounding the transaction is paramount for tax reporting. And I see that firsthand at Camuso CPA. And also the non-compliance rate is still, persistent, even according to the IRS. I know they've recently cited a 75% non-compliance rate. And at my firm, we're still reconstructing basis for back 5 to 10 years. And data becomes a huge issue when, people are dealing with high volume of wallets or exchanges that may be defunct. So, these are huge challenges that are still plaguing taxpayers to this day to a large degree. Now, the 1099 DA is kind of bringing in this new phase for the IRS and really bringing crypto into the compliance era to a large degree. And, I believe maybe, going to help address some of this non-compliance rate. But, from your perspective for listeners, what is the 1099 DA actually to accomplish for the IRS? And, what structural problems are they attempting to address with this?
I think in my mind, it'll accomplish two things. Those two things are both to benefit individual taxpayers, or I say individual taxpayers, but whether that's an entity that's doing crypto or an actual individual person. The first part of it is a little bit of addressing this data problem. It's going to make the data more easily understandable by making the data structure look very similar to what all of us are probably used to seeing historically when we do traditional financial transactions. With a broker at the end of the year, we get a form, tells us what we bought, how much we paid for it, or what we sold, how much we received for it. tells us the insights into the tax calculation number, capital gain calculation. So you know really what to put on your return or to pass off. You have all the information to pass off to your preparer, who can then put it on a return. That will achieve two things. So that's what the 1099 DA form is intended to do. The first year of its implementation, it's going to cost basis component. So there'll be a struggle there. That more has to do with just allowing the broker, the custodial exchanges, to get everything set up and running. But in the second year that it comes online, so that'll be the 2026 tax year, it'll have all of that information. The goal there, I think, is twofold. One, it's to help with this compliance problem by giving taxpayers who are conducting activity with centralized exchanges the ability to have all the information they need to properly report their taxes. Then it also simultaneously helps in two ways. One, it allows them to reconcile because they'll get the same form, so they can easily identify where there's issues or inconsistencies on a tax return, which is good because then they know who to audit or who to maybe send a letter to. As practitioners, there's a variety of letters you might get even before you get into a full-blown audit. But separately, I like that it also tells them who not to audit. If you've been doing crypto a long time as a practitioner, there's been various where the IRS has sent out letters based on certain crypto information, and there's a tremendous amount of those people who actually were compliant and they got a letter and had to deal with the IRS for a while, just uncovered they reported correctly. So it should help clean up and create more transparency and certainty around that, so the IRS can do its job to focus on non-compliant taxpayers, but also help taxpayers be compliant, because I think there are a number that still to this day may not report simply because it's too difficult. Yeah. Now, if they get that information, they'll be much better off.
Yeah, it's going to be an interesting year with the first year of these coming out, and seeing what it does to those compliance numbers, I think. Many have described the 1099 DA as a data infrastructure challenge as well, for the companies that are going to be managing and issuing these forms, even to a degree the taxpayers that are going to have to reconcile against them. Can you walk us through some of the data flow? I know you were that a bit on, what is it actually from the exchange to the taxpayer to the IRS, and what sort of operational demands is that going to create on both sides?
Yeah, I think there's a couple steps there. As we talked about originally, like right now, if you're a practitioner in this space and you have a client that is doing crypto activity, that client might be able to go to various custodial exchanges, and I refer to custodial exchanges. They're generally the ones that are going to be governed by this new reporting regime. So that just subcategory. And if your client exports data from their account, usually via CSV, or they all look different. And sometimes it's uncertain if all of the data you need as a tax practitioner is there. So you had a lot of these custodial exchanges. My experience is when this was an early industry coming online, a lot of building was done to focus more on customer focus to allow certain types of trading, as well as building to meet the crypto ecosystem, not necessarily building for tax compliance. So now you have a lot of systems with brokers that are not designed with a standardized data structure across all of these brokers. So there's a lift there for them to go and make a bunch of internal architectural changes to their system to be able to get the data endpoints that can fill in the form the right way. That's a role like here fit. That's one of our side of government work. We provide a lot of enterprise services to help company that reporting and get their systems up to date. So that's the first step. Now the flip side of that is the IRS side. You have custodial brokers. They're going to be firing in all of this information to the IRS. We've heard at times that the number could range anywhere between 4 billion to 8 billion forms. It'll be interesting to see what actually happens. There's some running jokes about whether the system might break. That's its own IT problem for the more forms we ever received, even for like 10Ds for normal traditional financial trading. So they got to get all of that information. And so this, one of the side things coming out of 1099-DA will be a sort of coalescence or a convergence of data standards. So we will, as practitioners, will start to see data be more aligned, even I think as users export stuff, not on the forms, which I think will be very beneficial. But that'll be the hurdle. It'll get there. It gets all the data. They've got to figure out what to do with it. I think the next problem I'm sure they're trying to solve.
Yeah. And, the lack of decency that you're referencing is something that has plagued practitioners for, the better part of a decade now when it comes to the exchange. And I'm sure even on the software side as well, at companies like Taxbit that also have to ingest this data, getting some normalization and some consistency is I think is going to go a long way. And I would imagine that's probably has been one of the biggest challenges, like you said, for these brokers that are falling under this definition, is really getting their data consistent and able to meet the standards of this reporting.
Yeah, 100%. That's why we've seen the line for implementation of 1099 have a little bit of delays, like proceeds 25. You'll see forms coming out in early 2026 for 2025 tax year. Just going to be proceeds side only. Then the next year is going to be cost based. And then we are, as practitioners, we are still waiting on the IRS and the Treasury Department to issue final regulations for what is known in the traditional financial industry under Code Section 6045 Cap A, but it's the cost basis transfer among these brokers. That hasn't even been finalized yet, but that'll help. That'll come online at some point. And part of this is the need for these companies to sort of build this type of reporting.
Yeah, the challenge all around is getting the cost basis accurate when it comes to digital assets. And something that kind of goes along with the theme of 1099 DA is Revenue Procedure 2024, which we saw finalized last year, with changes to it earlier this year. And for the most part, it's an end to universal account-based account assets. And I've seen is somewhat of a divergence in interpretations around the revenue procedure and how it's going to apply, particularly to non-custodial wallets, where excuse me. But sorry. So I wanted to say, there are these non-custodial wallets emerging treatments when it's to the basis tracking and how the revenue procedure up to non-custodial wallets that I'm seeing with practitioners. Some still want to more or less apply universal pooling across non-custodial, apply the account-based tracking when it comes to broker-held digital assets. Some are treated per account. So that's going to be another, upcoming tax reporting issue from an IRS perspective, where there's going to be diverging reporting coming from different tax preparers and different taxpayers. So is that an issue that's on your radar, and how do you think the IRS is going to approach that overall when it comes to, enforcing this and even interpreting it?
Yeah, I agree 100%. This is an issue that has a very large question mark above it, and it would, as you kind of described it, in my mind, it boils down to in the Rev Prop, when it says by account, everyone seems to agree, like, okay, that's custodial account. In the same way we think about traditional financial accounts, that's my account at perhaps Kraken or Coinbase or Gemini. That's easy. By wallet, I think for me, there's a term, like, what do we mean by wallet? Do we address? Or doing wallet as sort of your MetaMask wallet, which might house a bunch of addresses. Exactly. And then you have variants in blockchain types. When you move to on-chain, you have UTXO blockchains with co-spend. So think like Bitcoin, Litecoin. Those are all UTXO-based chains. Or you could have Ethereum-related chains that are accounts-based chains, where it's the address seems like it should align to an account because everything is in that one address. If you're on a co-spend like UTXO chain, you actually could have spending multiple addresses working together to be, co-spend items. So they kind of maybe should treat it as one wallet. I have heard the stuff. I'm not sure what the IRS is going to do as stuff comes in. I think they're we're a little unsure as they. My guess is they're hoping for whatever you're doing, if it's consistent, which is great if an audit and someone says, hey, you've done it consistently, we'll let that. I'm a little more upstream when the IRS is doing compliance reviews or case selection, like who they might audit to check what is going to come out of that, or misunderstandings if you have tax return A filed using one approach, tax return B filed using a different approach. Then is going to be able to maybe isolate where there could be an error there. They have to program them in a certain way. And again, we're dealing with non-custodial stuff, which they don't even get information on anyway. So there's already a missing data piece, IRS, where they might be trying to risk score things. What's the chances that this is right or wrong based on what's filed on the return? So it's
Absolutely.
really important to know. I've had this conversation even with some former IRS colleagues that are unsure what it is.
Yeah, it's interesting, and there's, like you said, a ton of diverging perspectives, and it's going to have to be seen. Approach is taking a consistent approach. Also, looking at a case reasonably based on the type of wallets and structure that a client can have. Another issue I've heard raised in my practice is sometimes have hundreds and hundreds of wallets. Even become admittedly burdensome. So to start doing it, doing the tracking on a wallet by wallet basis, and to a certain degree, then I think you have to look at consistency, and you need to look at also what is the actual use of each one of these wallets, and that whole entire compliance plan and how you approach your accounting. You consider that as well, like these companies that may have very large volumes of wallets for operational reasons or other reasons.
We have, and that especially I know part of your role outside of tax is also like outsourced CFO work. We do here at Taxbit, one of our other enterprise commercial lines of business is supporting from a financial accounting standpoint companies that have crypto on their balance sheet, primarily companies like miners, and that they may have hundreds and hundreds of addresses. And some of those addresses, we describe it internally as good wallet hygiene. Like they'll have it like, this is the address where we earn rewards from this particular mining pool operation. This is a wallet where we run our own while we get stuff here. So internally, if they track all that very nicely, it becomes easy, but it's hard when you start to get so many of them to track it. So the problem where you raised questions about like, how do we bucket all these? Do we really have to track this at this granular level? And there are very high-level questions we've talked with companies in the industry we engage with around really to do this. Sometimes the answer is like, well, you can go get software, tagged software like that. But there's also a question of like, yeah, but should have to spend thousands of dollars on software for compliance reasons because it's so overly difficult. And there is a rub there. Like, what's the cost of compliance, and when does that cost become super burdensome?
Yeah. I think it's going to be an ongoing issue that I'm trying to raise more attention to on here, because I think it's something that I want to get more industry input on overall, and publicly, and start to gain some more perspectives than some of the people maybe I see posting about it on Twitter and some of these other places here. Another big question is around stablecoin. Obviously they're not looked at or defined as cash equivalents right now, and there's the potential that to a degree they need to be included on the 1099 DAs in the future. And I think you already spoke a little bit to the sheer volume of forms and information that the IRS is going to be getting once this tax reporting comes out. So what's your perspective over it?
Yeah, stablecoins pose an interesting question, partly because, especially in the past few months, we've seen a massive explosion in use case for stablecoins. So even within the crypto ecosystem, stablecoin usage is going to continue to grow, which under the current regime, and we just saw at the end of the summer, the president of the White House put out their crypto report. They still stick to stablecoins are still crypto, so they're property. They aren't a cash equivalent that gets treated a little differently, which means generally they would be subject to capital gains treatment. Also means they'd be under the 1099 filing requirement. We do know that Treasury, when they finalize the regulations, allow for aggregation of stablecoins for certain things that meet this definition they gave in the regulation of stablecoins. I'll be curious to see where it goes. I have seen, and I kind of sit in the middle. There's part of me that would great stablecoins because they're stable, especially now that we actually have like the Genius Act, and we'll see how that comes into play. There should not really be a lot of gain or loss shown on those transactions, which then begs the question of like, why do you need reporting? So you could have a step to reduce the reporting. However, in my experience in doing this for a long time, I've seen people who arbitrage stablecoins and make thousands and thousands and thousands of dollars off stablecoin slight movements. So if all of a sudden you remove the reporting on that stuff, and that actually I've seen that as a pain point with taxpayers, where they're like, well, no, I just was buying and selling stablecoins. My gain loss had to be zero. No, we can show, like, you could see that it's actually like $40,000 that needs to be reported. So it's a tough question. The way Treasury approached it for now, with the ability to aggregate those up at a certain level, seems like for the moment a sensible approach, but we'll see how that pans out as stablecoins keep ballooning in usage. Something needs to be taken off the table.
Yeah, there has to be some balance with, bringing crypto fully into the tax system with preventing just, superfluous reporting. But I agree, we need to see some form of reporting on there. And for the time being, it may not be the worst approach to be reporting the aggregates, like you said, and it leaves flexibility for the future and to kind of see how this develops as well from a tax reporting standpoint and from an industry standpoint. So 1099 DAs are coming out, and there's this huge non-compliance rate, and obviously, when you're seeing investors and some of the crypto people talking online over the years, they're not too worried about tax enforcement. They think maybe this administration is more friendly to taxes and these types of things. But we're going to see this third-party reporting coming out. And, how do you see the IRS's enforcement priorities evolving? We've had some high-profile cases this year related to crypto, but now are we going to start moving into, a deeply data-driven, algorithmic-driven approach to some of these crypto audits, and probably seeing tons of tax notices go out when 99 DAs start matching up to people's tax returns and things like that?
Yeah, I think it'll be interesting. I'm not sure if I have a good answer as to where the IRS is going. I think the initial plan will be, from my perspective, from the time that I spent there, is we'll have year one this year coming up where they will receive the forms as kind of a test year to see, okay, what do they say? What can we do with the data that's available? And what does it look like? Maybe in year two, when they start to get a handle on it, we'll start to see it ramp up. The question is in which way. I do think the IRS has an appreciation for the fact that even 1099 DA reporting, while helpful, isn't going to be the end-all, be-all, because it's going to be incomplete. It will not cover the non-custodial piece. And given that even the non-custodial piece doesn't seem to really be anywhere, have brokers, there was finalized rules for DeFi that were then basically invalidated or repealed through the Congressional Review Act. So you'll also see a lot of people moving into that part of the ecosystem, and that causes probably some concern, not for tax non-compliance, just for data visibility. Like if you just think generally, like there's going to be less data. Very curious to what are they going to do. I don't know if you'll immediately see a rush in year one or year two, but maybe by year 3 or 4. And they also, at least in my experience with crypto, was somewhat of an opportunity to, like, knowing that this is a novel industry and allowing people to get up to speed, like the change you mentioned with going universal to by account. There's some friction there that's going to happen. And I think the IRS understands that. And so they're not running to do it. Plus, we also know under the current, the IRS is very much under fire. The government's shut down right now. They have lost a lot of manpower. So there's just a different, just very practical question of where are they going to be able to have resources to do anything in the near future. But it will catch up.
NDAs could be a push to getting people to report, and they have one more chance to maybe get into compliance before these test runs happen, and it will take some time from your perspective. Makes sense. You brought up another interesting point. The inclusion of decentralized exchanges in the definition of a broker. And it's been, a big point of industry contention overall, where it was in the, proposed regs, final regs. We saw it pulled out last minute through the congressional review. What does that tell you about the future of tax reporting and how it's going to apply to DEXs? This was, something that in a future administration may be repurposed and included in the definition in the future. And, should these protocols and DEXs be preparing from, an information standpoint to comply with this in the future?
Yeah, I think from my take is that because element of the regs for decentralized finance were essentially invalidated under the Congressional Review Act, the legal process that happens there really binds the hands of the Treasury Department or something to go do new regs, because they have to do new regs that are considered, whatever this means, substantially different from the ones that were invalidated. I don't know how they make them substantially different, so that's going to be subject to all sorts of legal challenges if they came out with something and tried to be substantially different. I really think the miss there, this boils down, and you mentioned kind of definitional. It is a definitional problem of what was meant in the Infrastructure Investment and Jobs Act when they passed this whole reporting regime, and they added kind of layered in digital asset brokers as a definition in the statute. Like whether the scope of that was meant to include DeFi or not is like the question. A lot of people from the industry side don't think it was meant that way. Some people, clearly the government, thinks it was meant stuff, and you could probably look through all sorts of legislative history and try to figure it out. No one knows. What I think is probably not much will happen until there becomes a clear picture from Congress of like what's meant to be included, or just a significant political shift where like maybe Treasury could do something and Congress won't come after it, but it'll still be challenged legally. And there was, even before the Congressional Review Act went through to invalidate those regs, there was a challenging those regs under the APA, under the Administrative Procedures Act. And that was that lawsuit's now been dismissed as moot because they went away and they were no longer regs. That would have been interesting to see how it plays out, because it would really put this definitional question to a judge who, in our world, judge to interpret the law. They would have been able to interpret what did the statute mean as written by Congress. And then we would just know. Everyone would have a conclusive answer of are they in or out. But until we get a conclusive answer on that, I don't know if Treasury's running super fast to try to do something to bring them back into scope.
Interesting. Yeah, so it'll be interesting to see how that plays out. And it all comes down to the definition, like you said. So, I think another interesting point is something that was raised during, some of the recent Senate hearings that we saw early in October around digital asset taxation. And some of the discussion centered around direct on-chain verification for tax reporting purposes, where the information can be sent on-chain directly to the IRS, and to a certain degree can start to replace some of the legacy reporting systems with tax-based forms, and you can just match on-chain activity directly to taxpayer reported activity. From your perspective, could a framework like that ever really gain traction? Obviously, it's probably far in advance. What sort of procedural or technological evolution do you think would have to take place for on-chain verified tax compliance to start to replace some of the legacy reporting systems?
Yeah, I think it's a super cool concept. Technologically speaking, I think there's a path to do it. But my view is something like that is 5 to 10 years out. There's obviously doing that requires a number of legal changes, requires a number of technological developments, as well as adoption, sort of network-based adoption. You need everyone to kind of agree that we're going to do it that way. And so the legal side be very difficult to get some of that through Congress. And then the adoptions, it's expensive. It's resource intensive to build out all the systems to be able to do that. The part that I see is the biggest barrier is also that might be something that works for the crypto ecosystem, but then it doesn't really carry over to like traditional finance. And so now you have like a separate system for just one niche part of the financial ecosystem overall, which seems a little weird. The other part that I always kick around is usually the reason for this push is privacy concerns, right? That's the reason we have a lot of pushback about wanting to share. And there's some merit there, I think, to privacy concerns in the crypto sector. In the tax space, you could have a client getting audited. Maybe the IRS can summons bank account records, whatever. But those are snapshots in time. Like you get a bank account record for a certain window, it's done. Once the government gets a hold of someone's address, that address lives on forever. You can go anytime and look at the blockchain and see what's happening to that address. Obviously, as taxpayers, there's good privacy things for like address hygiene. Not always using the same address forever. But if we do the on-chain identity thing, I don't know if you really fully escape that problem, because if at the end of the day, the IRS knows, hey, this taxpayer did these transactions, they can kind of reverse engineer everything off the blockchain. So are you building a whole system to solve a problem that's not really going to solve the problem you're concerned about? And that's where I'm sure there's an answer to that I'm not smart enough to know. There's builders, like they're way smarter than me on how you could obfuscate that. But it's a little ways out. I think it's super fascinating, and it does show the progress, like the technological evolution phase that we're in of how like fintech is evolving. So there's something there, but it's definitely a little ways.
Definitely. And you brought up a good point. When it comes to talking about DEXs included in the broker regulations or any of this on-chain tax reporting, or even state level reporting where they get involved in the future from a sales tax perspective or other perspectives. Really, one of the things that this all boils down to is on-chain identity and privacy. And, to a certain degree, I think that's where a lot of the friction comes between the industry and regulators, where they do want to preserve that privacy on-chain and not disclose their on-chain identities necessarily. But for reporting regimes, to a certain degree, you need it one way or another, like you were kind of alluding to a moment ago. So is there an actual realistic framework where we're going to have decentralized systems that are going to be able to, have verifiable compliance without having these sort of anchors that are going to tie an identity to a way or another? And to a certain degree, if the answer is no, then, is the industry going to have to find some sort of, spectrum of privacy or, some way to accepting some form of identity verification on chain?
Yeah. And I ultimately feel like the path you're on is where it may end up landing. I mean, I've also learned, though, not to count out the that the industry has on how to solve problems like this. And so I pause to say, like, it's not ever would never happen, because I actually think it really could. But I do think at some point, if it happens, at least if it happens more quickly, it'll be some sort of middle ground where there'll be some concession of, look, you have to share some information about yourself in order for the government to be able to validate that. But keeping it limited, if there's a way to do that, it probably can happen. Right now, there's a point where the government just says, oh, like, well, it's financial data. And there really is, from a legal standpoint, the concept of financial privacy is not really something that exists in the way we think of other privacy rights. Like it's usually created by statute. And you have to keep the rules, but there's not always a Fourth Amendment right to financial privacy. But there is a trade-off here where, as I mentioned, like the ability, once you have someone's address, you kind of surveil her. The flip side of that is if you and I interacted on chain, you could surveil me forever. And so there's sort of the privacy question there. I don't know if I give you my stuff. So it's an interesting problem. It really brings privacy rights and technology and tax, like the government's involvement, to a head. And so I'm very curious to see how it plays out. And I see the arguments all around, and it's hard. Like I find myself falling on each side of the answer. Yeah. I don't want to share any information. And then you're like, well, I used to work in the government. I appreciate they need some stuff to know if I'm doing things right or wrong because they have a mandate. And then the accountant person in me or the lawyer, the tax lawyer is like, well, but we need to be able to know what our clients are doing. So even when we do returns or advise people, we have some ability to trust what they're doing. Like we're putting the right stuff on the return. So there's different motivating factors, I think, there, depending on what the answer will look like.
These tax issues are really bringing these topics to a head, and I think they're going to be, largely defining for the industry as we enter the next 2 to 5 years. And people really start to focus in on this more, and some of this compliance architecture gets defined. So I think this is a really interesting conversation, Miles, and you bring on a great perspective. So I really appreciate you taking the time to speak with us. If people want to get in contact with you to, speak directly more with you or directly more with Taxbit, what's the best way for them to get in contact with you?
Yeah, you can always find, Taxbit's at www.taxbit.com. If you're a broker that's subjected to the regulations and you're working to do that data cleanup to get on board, feel free to reach out. That is specific. If you happen to be on the government side and you're an agency somewhere that's working on needing to work with crypto data for investigative purposes or whatever, again, feel free to reach out. Other people, you can always find me on LinkedIn or just miles@taxbit.com. I'm always happy to chat about these issues because of my background coming from the IRS, and I'm still like a tax lawyer at heart, even though I work at a tech company. But I think it's a novel space. It's super fascinating, and it really does bring to head like technology, regulatory regimes, and tax. And so it sort of brings them all together in a way to have really novel and interesting conversations about how it's all going to work over time.
Absolutely. Well, I really appreciate your perspective, and hopefully we'll have you back as a guest in the future when we have some updates with the 1099 DAs and other developments from an IRS standpoint when it comes to cryptocurrency taxation. So to everyone that's been here, I encourage you to reach out and get connected directly with Miles, have a conversation with him if there's something on your mind. And for everyone watching, I hope you took some value from this conversation and maybe saw something from a different perspective or a new issue for some of your clients or just your practice in general. That's what we're looking to do here on the Financial Frontier, bring some of the most important issues for our industry to the forefront and bring on some of the best guests to help dissect them. So thanks again for being a guest. I really appreciate it. Until next time, I'm Patrick Camuso signing off.
Awesome. Thank you.